We wouldn't read too much going into the Fed. The market's going to be pretty volatile for the balance of the year. We would not chase the rallies. Rather, we would buy into the sell-off. So you just had a pretty good start to the month, significant rally. So we would not be putting new money in. Having said that, there's still a lot of stocks that we think are pretty attractive.
All right, so let's talk about the stocks you think are attractive. This is your shopping list. What exactly goes into that kind of a shopping list if you're not chasing rallies but waiting for pullbacks to happen?
Well, basically, we're looking for companies that are selling at reasonable valuations, typically under a market multiple, and are paying a pretty good yield. So right now, the Treasury is at 2.1 on the 10-year bond. If you're buying stocks that are paying 3 to 4% in terms of dividend, you're getting paid while you're waiting. So if there is this volatility, we think those stocks hold up pretty well.
What types of stocks are those? I mean, we know what the high dividend yielders typically are. They're consumer staples, they're utilities, real estate maybe, but some of those sectors are pretty stretched in terms of valuation.
Exactly. So those sectors have had great runs. So what we're saying the high dividend stocks you want to focus on now are more diversified. Companies like a CVS, which is in the healthcare group, AbbVie also in the healthcare group. One that we'd mentioned earlier is Home Depot. Home Depot pays about a 2.7, 2.8% yield. They are a direct beneficiary of lower interest rates, of more home refinancing. So we're expecting their business to pick up pretty well. You're getting them at a very good price.
So take us through this. As interest rates drop, the idea is people have the ability to borrow more money and then fix their bathrooms, fix their kitchens, do work around the yard. Home Depot is the best play there. What about Lowe's?
We think Lowe's is pretty good, too. We like Home Depot better simply because they pay a higher dividend yield. So you're getting both the valuation and you're getting the dividend kicker.
All right, so let's talk about whether or not the Fed factors in. You said don't kind of figure out the chasing rallies part of things. Is there anything that the Fed can say this week that would make you feel any worse or better about what's happening with the markets right now?
We don't think so. What's clear is that the Fed is pretty dovish, whether they lower rates this week or they lower rates next month. The Fed is going to be lowering rates this year, and we don't think they're going to be particularly aggressive in 2020. So that's a positive for the market. The biggest wild card for the market right now is trade and China. We think if there's no resolution, if there's an escalation, we definitely worry about the market and a pullback. We think if there's any sort of resolution, whether it's good or bad, just put it behind us. We're pretty bullish on the market.
Does it seem, though, like over the course of the past 6 to 9 months, we've seen umpteen trade headlines indicating incremental progress or incremental regression. But it seems as though the market has become a little bit more immune to those trade headlines. They don't move as much as they used to. So is it really that much of an uncertainty point at this stage? Because we know that an overarching trade deal, and Commerce Secretary Ross said it, don't expect a big deal when President Trump and President Xi meet, if the meeting actually does happen.
We think it does have a very significant impact on the economy and then the stock market. You did start to hear in the fourth quarter companies say that their business was slowing. They were worried about tariffs. You had the worst fourth quarter in 10 years. As it looked like trade was getting better, you had a great first quarter. As it looked like the trade deal fell apart, you had a very significant sell-off in May. So we think right now the market is hopeful there's any sort of deal. If there really isn't a deal, if Trump digs his heels in and they don't figure something out, we think it's bad for the global economy and it is going to hurt our stock market.
And where are there places you stay away from because of that uncertainty?
We think that the reality is if there is a no deal and the market sells off, a lot of things are going to get hurt. So if you have equities, you're going to get hurt. So stick to your long-term asset allocation. We would not get spooked out if it looks like there's not going to be a deal because we think ultimately there has to be a deal if Trump wants to try to get reelected.